Hello, everyone, and welcome to today's webinar on financing ground-up construction projects. Today, we were going to talk to you about this great program that we've been getting so much buzz about. So as questions occur to you, please go ahead and use the questions function, and I will ask them on your behalf. So we're also going to have additional time at the end for additional Q&A. So we want this to be as engaging for you as possible. So please go ahead and ask questions as they occur to you. With that, I'm going to turn it over to today's speakers. Take it away, Jim.
Good morning, Rose. Thanks, Rose. Good morning to everybody out there across the US of A. I'm sure we got 47 of 50 states represented on this call. And we do fix and flip and ground up loans in about 48 states. So I thought I would start with this. This is called March Madness. Here's my bracket so far. Lost, 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 lost. As you can see, I'm not doing very well, lost. Okay, that's where we're at on that program. Maybe we can make our loans a little bit better than that. So about us, who's LendSure? What's LendSure? Many of you are familiar with us. We're a non-QM lender. That's our platform. So we're doing lots of loans for self-employed borrowers, et cetera, that can't work on tax returns, but they do work on bank statements. So our main book of business is a non-QM platform, wholesale for mortgage brokers and mortgage bankers. 10 years old. I was one of those guys that was around during those startup days. Based here, we're around the country with different centers, securitizer our loans, highly experienced management team. What does that mean exactly? It doesn't mean we're old. It means we're seasoned. Right, Kathy? We're seasoned.
Yes, seasoned vets that know what they're doing.
We do loans in about 50 states, not quite all. We don't do any loans in Fairbanks or Nome, Alaska, and places like that where there's no neighborhood. We don't do those. Okay, that is enough about us. The next slide is going to talk about what's driving all these inquiries, what's driving the ground up business. We knew it was getting hot from our experience in fix and flip. So we started that venture, getting out of non-QM only, and got into this business of financing projects for investors about three and a half years ago. And a lot of the brokers, loan officers are asking about ground up. So the more we heard about it, we took a look at it, talked to our investors that lend money to us, and we got in this ground up business because there is a good market opportunity out there. Got in this in a full-time basis about 6 months ago. So opportunity is great. Our customer that we target is the small builder. We're not out after the big building firms that build 2,000 homes a year. That's a bank business. We're looking for the builders that build 2, 3, 5, 10, maybe 15 homes a year. They'll build on a spec basis to sell, or they can build a property to hold and rent. So the program is designed for builders and investors who want to build, hold, and rent. It does not work for, I'll qualify this up front. We don't have a program to date that allows us to do a new build for a owner-occupied scenario. Reason is, we don't have any income requirements on these loans. We treat these as business purpose only, BPO loans. They're LLC closings. They're not in any personal names. So it's a business loan that's not regulated with all the rules and regulations around consumer-based loans. We don't require any income. The good news around that aspect, no DTI analysis, no tax returns. Builders and contractors are very good at building things and getting a home square and making it look professional and doing it right and building to code. They're good at that. They're not always the best at paperwork. So the no income thing helps in the sense that it's an easier underwrite up front. There's less analysis, less red tape, less paperwork. No income doc means less red tape. One of the unique things about our program, and we'll put up an example of the number one question we get is, how much money can I borrow for this project? How much can I get? That is that is the question of the day, right, Kathy?
Yep,
They
yep.
want to know, I'm going to build this house for X dollars. I bought a lot for X dollars. How much can I get? So one of the niches to our program, a lot of banks will not do this, is builder buys a lot. He buys a lot for a future job. Today he's working on a current property. He gets it done. Good news, he's got a lot to build on, so his income can continue because he's got a new project lined up. When they buy a lot and pay cash, let's say they buy a lot in Florida for $200,000,
Mhm.
they now want to start a build, they got plans, they got permits, they can borrow money against that lot up to 60% of the 200 that they paid. In that case, 120. So that's a cash out loan on dirt. We don't have any collateral, we just got a piece of land. That's a niche, and that drives a lot of business our way. On the cost to build, we'll talk about that more in detail, but we'll end up to 85%. Next slide. I mentioned what's driving this. One of the big things that's driving it is low inventory. How many people sitting from Maine to California, like me, are camped out on a 2.75% rate, not about to list my house and move and buy something else? So
Mhm.
that's driven some of this new build demand, so people can get into the business of owning a home. And it's been, I would say, rather robust. Would you agree with that, Kathy?
Absolutely, absolutely, and
How,
only
how
getting
many
stronger.
how many new build calls do we see a day? Calls or inquiries?
At least, wow, 15 to 20, I'd say.
Yeah, that's about right. So we're getting inquiries like, I don't know, 80 to 100 a week.
Yeah.
So it's hot. Next slide, we'll talk about where are we seeing the most business. What's not on the list where we see a lot of business is Florida. And Florida meaning from the Panhandle all the way down to Miami. Lots of available lots for sale in Florida, lots of builders in Florida. And of course, there's that demand where homes have just disappeared due to weather issues called hurricanes. Now we're rebuilding a house. So that's probably number one on the list. Lots of deals coming in recently from Nashville, Tennessee. We see business. Phoenix just approved one in Phoenix for 1.8 million. Seeing deals in odd places like Connecticut, New Hampshire, Michigan. They're all on the map. Next.
We just had a comment that Ocala, Florida is another hot market for this type of loan.
Booming, no doubt.
And
Mhm.
Jim, what is the experience requirement for ground up construction loans?
Kathy, you want to take that one?
Yes, they need to have a minimum of 3 completed ground up projects. However, say that they have 1 completed project, but they've also completed some major renovations, like for fix and flip. You know, but that those types of deals would be considered as well. If they had the one ground up plus 2 or 3 major reno projects that are comparable to the project that they're currently looking for financing, yeah, we will consider that as well. But we do advertise that they need to have a minimum of the 3 ground up projects completed.
Good answer.
Kathy, can you work with foreign nationals?
Not on the ground up
Fix and flip,
program.
fix and flip,
Fix and flip
yes.
we can, yes. Fix and flip, yes. Ground up, no. Not at the present time.
And is LO licensing in the subject state a requirement for this project or for this product?
That one I'll take. MLO license is required in certain states. I can name a couple of them. Right off the bat is Nevada.
Mhm.
Another one is New Jersey. So in those cases, yes, I have to have a licensed LO to be able to do this loan. I think
Okay.
it's about 5 or 6 states. Next.
And when you were talking about the experience, lifetime experience or just the past 3 years?
If someone's built, let's say they built 5 homes and they built one last year and the other 4 were built in 2012, we're going to look at that deal seriously. It may be an exception, but that's a small exception. And that's something we can normally get around, particularly if they have at least one compensating factor. FICO score is 820, for example. We'll
All
look
right.
at those deals.
And one more question about the experience. And are you talking about the borrower's experience or the contractor's experience?
We're talking about the borrower that signs our note. That person has to have the experience. Hiring an experienced builder does not qualify the deal. It's the borrower investor that we're trying to qualify with experience.
Okay, great.
Next slide. Investment properties only, we mentioned that 1 to 4 units. We don't build, 8-unit, 16-unit apartment buildings. Another reason I didn't mention on why is the market so hot. Average return on these things is 25 to 30%. That's a good rate of return on your money. It's hard to get 30% returns out of the banks today. And hey, the stock market's out there, but wow, could be risky. Next slide. Maximum leverage. So that's the question of how much can I get. The maximum we can lend to an experienced builder is 85% of the cost to build the home. Cost to build would be the number derived from the plans where the builder and the architect have worked on how many square feet we're building and what's the cost. So if the cost is 400,000, we'll lend 85% of that. In addition to that loan, if the lot's free and clear and they pay 200 or more for the house, they can get cash back against the lot as well. Target location, like we mentioned, we're not doing loans in rural America, infill type locations where there's other, simply meaning where there's other developed homes or developed residential areas in the area. Rules of the road. Investors, max loans 3 million. We've done one of those at 3 to date. Approved lots, meaning has the county or the city authorities, town authorities, issued a buildable permit, and are there services at the curb, meaning water, electricity, fuel, gas, oil, whatever. The simple way to look at that is we do loans ground up that are vertical. We're building up. We're not doing anything we're building this way, horizontal. We don't develop streets and put in sidewalks, not doing a lot of dirt work. So we're a vertical based ground up lender only. Loan amount, I mentioned 60% on the lot, 85 on the cost to build. And then there's a max of 85/70 on the ARV. ARV is a little different than loan to cost. Kathy, talk about loan to ARV.
Loan to ARV is the after repair value. So when we order an appraisal, we're going to always get an appraisal that gives us an as-is value, the property in its current condition, but they also need to give us a projected value of once the property is built or repaired, what is that value going to be? And we can loan up to 70% of that after repair value.
Okay. What about wells, septic areas? How does that work?
Fine, that happens. So permits required for an installation of well and or septic. As long as you got a permit, we're good.
And I've got a couple of different questions on licensing for the LOs. To clarify, 5 or 6 states require a license and the other 40 to 45 do not?
Correct. Since it's a business purpose loan, only a few states, regardless of business purpose or not, require that the LO, or on our end, in Kathy's case, the account executive is licensed. Somebody's got to be licensed in those 6 states to talk to the borrower. The other states treat these as true business purpose only loans, and they do not require a license for a ground up or a fix and flip loan, either way.
So, and then Steve says, I'm an MLO licensed in Hawaii. I can do these in multiple other states then?
Not in New Jersey, not in Las Vegas. Those 6 states, you need to be licensed in that state. So Mr. Hawaii can do them in about 44 states.
And I've got several questions on the recording. Yes, look for an email from me, Rose Waldy, about an hour after the webinar ends, and that's going to have a copy of the recording. I will also include a copy of these slides. I know we're going through a lot of detailed information. Don't worry about writing things down. Just ask your questions, and I'll make sure to get you that after the webinar. And Jim and Kathy, I sent you guys a note on chat.
Okay, what's on the next slide?
Kathy, you want to take this one?
Sure, absolutely. As Jim mentioned before, all of the loans have to close in an LLC or an S Corp, right, Jim? They can close in the S Corp as well, but primarily we look at LLCs. And as mentioned before, there's no income analysis, there's no DTI, there's no TRID. And the only thing, we don't verify employment as well. We will ask you about the borrower's employment. We do want to know, what do they do? If they're self-employed, give us the name of the business, tell us how many years they've been doing it. So that's all taken into consideration, but there's no verification of that employment or income. And then as far as our loan terms, we will do 12 or 18 months. It's all interest only. There's no prepayment penalty. They can pay it off at any time. The origination points, LendSure likes to net at least 2 points to us, possibly less on the larger loan sizes with senior management approval. There is a pro forma draw schedule from the builder or contractor, basically meaning that they need to provide us with a projected draw schedule. And it has to be a lender funded draws on the ground up, and no receipts are required on any of the completed work.
Yay, no paperwork, no receipts,
Yes.
less paperwork. Let's talk about the loan closing and the draw schedule for a minute.
Oh,
So the day we go to closing a loan, there's two things happening at the table. One is we're going to provide X amount of cash up front if they have a lot that's paid for. In some cases, there'll be no cash out up front. It'll be billed as all holdback. So think of it as if a lot's paid for, they walk with $100,000 or $120,000. The remainder of the loan might be $300,000 or $400,000 set up as holdback against construction. Not a penny, not a dollar of that money leaves the table the day of closing. So they walk out with cash based on the lot. They start the project. In this case, they own the lot. So what's job one? Grading the lot is going to be job one. Pouring a foundation is job two. When that work gets done, and those bills, those costs range between 20, I've seen between 20 and 50,000. The second that's done, the investor asks us for a draw to be reimbursed. And from that point forward to the $400,000 held back amount, it's that same process. Job gets done, we inspect. Once the inspection's cleared, we wire funds to the borrower, not to the contractors. We're not getting involved with the GC's contractors. Our funds are going to the borrower. So on loan one, day one, the only cash is the lot cash out if the lot's paid for. But remember, in some cases, that's not the case. So they're going to sign loan documents with no cash out. Important to note, we do not charge Dutch interest on these loans, meaning some lenders will charge interest even before a draw is taken. So you're charging interest on a loan where the funds haven't even left the table. In LendSure's case, there's no interest being charged until they take that first draw.
Okay.
Go ahead, Kathy.
Well, I pretty much covered this. Next slide, please.
Oh, I've got several people asking about the terms. I think we covered 12 or 18 months. And what's the interest rate look like? And what's the broker going to make on this? What's the compensation look like?
Oh, that's a good question. So interest rates on these construction loans range between 9.99% up to as high as 12.99%. So several factors determine what is that rate. First at the list will be experience, followed by size of loan, project, location, credit, assets. So strong folks with strong information sheets, meaning strong credit applications, lots of history, good credit, assets, they're going to get the lower rates. The focus is more on the points from contractors and builders and contractors and these guys, investors. They're more focused on points than they are on rate. They see these as very short-term loans. The point charge, the conundrum, that's what I use the word conundrum, with wholesale origination of fix and flip or ground up, is the broker must be paid. Our customer is the broker. We protect you guys first. Loan officers, brokers get paid day one, your point or your 2 points, whatever it is. We're instructing escrow to get you guys paid day one. So the conundrum comes around the fact that you want 2 or you want 1.5. We're the same. We're going to charge 2. So if you're 2, we're 2. That's 4. That's 4 origination points. Strong builders, strong buyers, strong people with lots of money are not going to they're not going to pay 4 points. So negotiation has to take place from there. We can get down as low as 1 point. That would be on a larger loan size. So if you're at 1, we're at 1. That'll win you more deals. You actually have a closing. So that's a negotiation point, and the point charge in the end will depend on borrower overall strengths. Okay, I'll stop there. Any questions? Any questions around that?
Does the project have to be completed within a certain time frame?
12 to 18 months. What happens is, next question that's going to follow would be, what do you do if the house isn't done and we're at month 17 and a half? We're going to foreclose and take the house back. No, we're not going to do that. We're not going to do that. If the project's moving along pretty much according to the plan, the draw schedule, we've had dispersed funds, and the house is 85% complete, we're going to extend it. There may be a charge. I'm not sure what the charge would be at that point in time. The last time we did this, it was a 1 point charge to the borrower to extend. It was on a property that was delayed in New Hampshire. So I can't say it's 1 point on every deal. It might be 1.5. It might be a half. We'll cross that bridge when we get to it, but we do work with people where their project's close and they're playing ball with us.
Okay.
Okay, how does it work? I used an example here of a $200,000 lot paid for 60%, 120, $400,000 cost to build, follow my math, times 85% is 340. So this loan totally funded would be 460. It gets to 460 a year from now because they're taking draws out against progress against the house. So they're only paying interest on the funds that they've actually drawn. We require, Kathy mentioned it, lender funded draws. We don't allow borrowers to fund their own draws with their own funds on a new build. A lot of reasons for that. I won't go into it. So in this case, we got a 460 loan amount. If you go over to the left side, you can see it under estimated closing costs, the LendSure origination fee, I used 2. In this case, we used 1 on the broker side. That could be 2 as well. But total estimated closing cost, $17,600. You can see the majority of those fees is in the origination charge. What's not in there is third-party fees. So in addition to that would be third-party fees. Initial loan amount 120, cost to close the loan 17. So what's the net look like on day one? Walk-on away money is 102. So that's a borrower that would qualify for the max, both 60 and 85. That's based on loan to cost, has nothing to do with the value of the house, what we call the after build value. Our loan size can't exceed 70% of that number, but in new builds, it's never even been an issue because most of these deals, if it's 460 in, they're selling for 700 or more. In this case, we had a sale price of 800,000. So 200,000 more than his hard cost. There are soft costs, such as carrying cost and finance charge. In this case, in this example, if it's 200,000 gross, the net might be 150. So if you think about, for the builder, $150,000 return, I got 460 in hard cost. That's a pretty good return. In that case, it's about 25% return on investment.
Okay. Jim, in the beginning, you said this is a builder spec loan product, but then you said the loan isn't to the builder. Who's the loan actually being made to?
The loan is made to a builder that's building a house that wants to sell it downstream. The loan is being made to a builder that's building a house that wants to rent it downstream, or an investor who has made a living out of building homes and he builds the house to hold the rent. The investor's got experience working with builders that have built homes. So the loan's being made to the experienced investor or the experienced builder. No owner occupied allowed.
Okay. And by the way, I'm getting some questions that are very specific, so I don't want to give false information or general information. So on those, we're going to have our team reach out to you and discuss the specific loan scenarios. What are the turn times on the draws?
When the job request comes in for a reimbursement, we order an inspection immediately. That's usually 1 or 2 days. After 2 days, the money's wired. If the inspection comes back that the work was done according to code, according to workmanlike manner, we're going to wire back inside of 2 days. We want the builder to have to get the money to continue the project. We want the due date, it's coming. So we're trying to get as much money out as we can to keep the project moving along.
Okay. Now, Jim, I'm getting some questions on this. If you can just go into the first bullet point a little bit more, because I'm getting things like, well, what if the builder is the borrower? What if the borrower hires a builder? So if we could talk about the experience and who the loan goes to, et cetera.
Okay, I'll say it again. The loan ground up loan is designed for builders that build homes to sell on speculation, or they may hold it and rent it. The borrower himself, a borrower trying to hire a builder to build a house for himself is not our program at this time. So no owner occupied. It's for builders that build homes. The builder is our borrower. The builder is our borrower, or the investor could be an investor.
Awesome. Thank you, Jim. Kathy, do you want to take this one?
Sure. So our approval requirements reminder, total blended loan to cost, as noted before, cannot exceed 85%. We do require for them to provide us the specs, plans, and permits, if available, at the time of closing. Again, the services at the curb, that is the having access to public utilities. Have to be available, even though they could have the well or septic, but there needs to be access to public utilities available. Jim, you want to take the infill location question?
I mentioned that earlier. Infill simply means we're building a house in an area where development has already occurred and services are in the area. That would be water, electricity, etc. We're not building a house somewhere in the middle of Colorado on 50 acres where there's no services available. Infill simply means the area's been developed.
Okay. And then, of course, we've already talked about the draw schedule. The first draw not to exceed the builder's investment, and how to calculate the loan to ARV. You divide your loan amount divided by the after build value or after repair value. That's not to exceed 70%. And then the loan amount divided by the cost to build should not exceed 85%. And the maximum square footage is 5,000.
I lied on that. I
You
put that
lied.
bullet, I put that in, there's a lie. Sorry.
Okay.
So we approved a loan yesterday, 20 miles south of Charlotte, North Carolina.
Mm-hmm.
This builder has 10 new builds experience. He built 3 homes on the same street. This house that he's building is 7,500 square feet. It was approved inside of 1 hour. The loan came into our system and it was approved inside of 1 hour, meaning term sheets. So we're going to talk about that right now because it's not mentioned on the slide. How do you get a loan to LendSure? I'm a loan officer. I got a realtor that referred me a new build situation, or I got an investor that referred me a new build situation. How do I get this thing processed and started at LendSure? One, enter the LendSure website. When that pops on the screen, there's a big button that says fix and flip or new build. Click the green button. It'll take you to an application, an online app. There's no 1003, no ERLA. The online app is going to take you 6, 7, 10 minutes to complete. When that application is completed and you hit submit, that hits about 4 desks here in San Diego. So we know there's a loan app in the system the minute you push the submit button. That starts the process. Our goal is to get you back a term sheet. Think of it as a pre-approval type situation, but in our industry, it's called a term sheet. It's one page long, and it will mention and disclose what's the rate going to be, how much are we financing, what's the draw period, what are the closing costs, cash to close is blank. So it's going to give the builder, the borrower, a picture of what the loan is going to look like. Once that's signed, comes back to us, that'll start the appraisal process. In the appraisal process, we need 2 numbers. One, as is value. That's easy. It's usually what the cost of the lot is. Beyond that, we send the appraiser a copy of the plans, the architectural plans, so the appraiser knows what he's appraising. They can then give us an ARV. So it's 2 numbers, as is and the ARV.
Okay, Jim, speaking of the land value, so let's say someone has had the land for a long time, but now it's higher in value. So is the loan amount based on what they paid for the land or the current value of the land?
Oh, that's a great question. It comes up all the time. It's like, reminds me of the fix and flip questions. When someone bought a house for $400,000 last month and now it's worth $650, we're like, wow, that went up 250 grand in 1 month. So we get that. So in this case, if the lot was purchased more than a year ago, we will then go to the appraisal number, which is the as-is number from the appraiser. If it's inside of a year, we use the purchase price. So after a year, go with appraisal. Good question.
All right, great. And I've been getting a ton of questions on exit strategies, holding, selling, all this stuff. So hopefully these will address all your questions.
Let's talk about that hold. Builder wants to build a rent portfolio. Investor does. When that occurs, and it does happen, we're seeing more of it, the loan comes due in 12 months or 18 months. The house is done. They don't necessarily want to pay off the loan. Now the loan officer says, oh, I'm going to get you a loan to pay this loan off. So you have 2 options. One, bring it back to Kathy or Jim at LendSure, and we'll work on a DSCR loan, meaning the interest rate's going to drop because the DSCR rates are much lower than a fix and flip new build rate. So that would be 2 loans for you, Mr. Loan Officer. That's a good thing. That's more revenue for all of us. Okay, any other questions?
For the appraisal, can they use their own appraisal services? How does that work?
That's a Kathy question.
We will order the appraisal. We order it through, we have 2 AMCs that we currently work with. So yeah, that's something that we take care of for you. You don't have to worry about the appraisal. We'll get that ordered. You do have to order title that, as far as being a loan officer or broker, but the appraisal piece is handled through LendSure.
Okay. And are the draws based on line items or progress, percentage of progress?
A little bit of both. So we look at the line items to be sure that the project is going along per the terms of the pro forma draw schedule, meaning the first draw should be for the foundation pour and grading. If we get a draw in, draw one comes in for new windows, we're like, how can there be any windows? There's no house yet. So it's line item, yes, and then it's the inspector's recommendation that the work was done according to plan.
Okay, and if the inspector, if the investor is building to rent, and you know that they are, is DSCR taken into account at, I guess, at that time, or do we
Correct.
wait until? Okay, great.
Good question. The DSCR ratio for an investor that's doing that, he's done it in the past. Let's say the ARV doesn't quite work out for some reason. So if they were going to sell it, that 70% number doesn't work out, doesn't pencil, but this is definitely going to be a rental situation. And you see these in certain markets like Gatlinburg, Tennessee, which is a high demand area for ARVs, or I'm sorry, for renting weekend properties. Those ratios, if it works to be 1.0 or even as low as 0.90 sometimes, will be taken into consideration and we can approve the loan based on the DSCR ratio. I was trying to say Airbnb. So Airbnb rents are looked at and considered when that is the play. When that's the play, we'll look at that Airbnb rent potential.
Okay, and then can we request a presentation be made to our client builder by one of you? Tanya, reach out to me after the webinar. I'm sure we can work with that. I can make a copy of this slide deck for you to be able to present to your realtors, to your builder clients, etc. I can work with you on that.
What do we underwrite for a new construction loan? Let Kathy, you start, I'm going to finish.
Oh, okay. Why location? Well, that's the first thing we want to look at is to see where's the property located, because as noted before, we don't do rural properties. So that's really, one of the most critical pieces is to see where's that location at. Is it close to a metropolitan area? Is it within a certain mile distance from a large major city? Then the project, we look at the architectural and plans as well as the scope of work. We look for zoning approval because we want to make sure all of that is in play and approved before we approve the loan, so that we won't anticipate those type of delays. Builder experience and reputation, the licensing, the workman's comp insurance, all of that matters. Those are all the things that we're looking at. Do they have the experience to take on a large project that they may be taking on?
Hey, Kathy, on this feasibility study and the profitability piece, I got an expert here, and I've talked 80% of this, so you guys are tired of me. I got an expert here that can talk about the feasibility and the profitability, why that is so important. His name is Luke. Hold on.
Hey, how's it going?
Luke. Got yourself into the presentation.
I did. So didn't really listen to much of what's going on so far, but I do want to address a couple things that are really important when we're talking about underwriting these. So location's a very important one. Location kind of determines whether or not we can how deep we can actually go into the loan, how much leverage we want to put into it. Experience also matters a lot. It's really what determines our leverage on the deal, but profitability is the main piece that I will be looking at to make sure that we can actually do these deals. So if a deal isn't profitable, it's something that I have to take a look at and kind of question, how can we get around this? Is there a way to get around it? So a lot of times I look at the purchase price of the property, how much they're going to put into the renovations, and calculate from there, based on their after repair value, how much profit is into, how much profit they're going to get from the deal. So, there's a lot of different ways to determine it, but yeah, that's kind of the main piece that we are going to be looking at. When it's a deal with good profit, it's something that we are going to be able to, push a little bit deeper on and go higher leverage. Um, and then we have a third-party feasibility study as well. So pretty much to make sure that the scope of work is actually, feasible, that the numbers that they're putting down on that make sense. We have to send it to a third-party company called CSFI, and they're going to look at that scope of work and essentially pick it apart and make sure that the numbers are accurate. So, for example, say we're looking at a kitchen and these guys are going to put down $50,000 on their scope of work to do a kitchen in a 1,500 square foot house. Well, that's kind of something that just doesn't really make a lot of sense in a lot of situations. Certain markets, it definitely could. If you're in a market where high end finishes are the, main attraction for a lot of houses, then it could make sense. But they kind of look at the market and then look at the scope of work, and they will be determining whether that actually makes sense, or whether it would be profitable for them to do that. But yeah, that's pretty much how I would look at it. No loan that I ever look at is the same twice, I'd say. So there's always something new that I get to learn when I'm looking at a different fix and flip loan or a different ground up construction loan.
All right, cool. Thank you, Luke.
Thank you, guys.
Okay, the boring myself back.
The funding process. Kathy, why don't you take us through this one?
So the funding process, you want to contact your LendSure AE. That could be myself, Lori Williams, or your non-QM AE that handles all of your other non-QM products. You discuss the scenario with us or them, and then it's about submitting the application, which Jim told you how to do that as far as going to our website. And under loan programs, you will see the fix and flip or the ground up construction. You click on those programs, and then you'll see the big green button to click to input your application. And it's a very short app. It's not a 1003, a ERLA. But that application, the questions on it gives us the answers that we need quickly to make a determination if it's a deal we can do or not. The turn time on once you complete that application and submit it, it goes into our portal. It's usually same day, no more than 24 hours. Someone will be reaching out to you, either ask for additional information maybe that wasn't on the app, or to question things, but the goal, as Jim mentioned before, is to get that term sheet out. That's, every deal we're looking at, that is what we're pushing for, is can we get a term sheet out on it? Once the term sheet is issued, all that we need to get it into, to really get the ball rolling, is we need it to be signed and returned back to us, as well as documents needed for underwriting, such as building plans, permits. Once all those documents are received, the first thing we do, as far as in the processing of the loan, is we order that appraisal, because usually if there's going to be any types of delays, it starts with the appraisal. So that's the first thing we do, is get that ordered. We also will order the property inspection. That's the initial inspection that we ordered. Luke mentioned about getting that feasibility study. That property inspection is the first step of getting that feasibility study. So the borrowers will have two inspections. The appraiser will inspect it, as well as our third-party vendor, CFSI, who does the feasibility study. Then and while that's happening, while the appraisal is being in process, the feasibility study's happening, we are also collecting all the other items needed, like the credit, the assets, everything needed to get the loan into underwriting. So we kind of want everything to kind of converge at the same time. The goal is to have the loan underwritten around the same time that we're getting that appraisal in and feasibility study. So then we can start moving the file towards closing.
Hey, Kathy, on number 4, it mentions conditional loan approval, which is industry standard. And if you work with LendSure, you see that all the time on our non-QM loans. Our average new build CLA goes out. It's normally 12 to maybe a max of 14 conditions. You'll never see 20 or 30 conditions on these. It's more like 12 or 14. But we have two people on staff that will work with you through that process of gathering the conditions and getting them cleared so we can move down to a clear to close status. Our goal is to work with you on that. In many cases, we'll talk to the builder himself with you on the phone. You're the lead, but we'll get into some questions that sometimes the builder understand because he's in the business, she's in the business. It'll be over everybody else's head. So we'll get everybody on the phone together to get through a project, particularly when we need to understand certain aspects of what the build is.
Okay, Kathy, I'm getting a lot of questions here about fees for the feasibility study, for the appraisal, any other upfront fees that are non-refundable. How much is it? Who pays for it? That kind of thing.
So the borrower pays for the appraisal up front. We order it, but and as soon as it's ordered, our AMC will send them a link for payment before they actually will schedule the inspection. We always estimate about $900, give or take. That could be less. It could be less than 900, and in some instances it can be more than 900. But that's the estimate that's reflected on our term sheets is 900 for the appraisal. Then we also have the initial inspection fee, which is with our third-party vendor, FSI, or in VMS. There's two that we actually work with. And that initial fee is $300 for the feasibility study. And yeah, those are both paid up front outside of closing. As far as the other closing costs for LendSure, you're looking at our underwriting fee. We have an underwriting fee for ground up, it's $2,500, and then we have our doc prep fee of
1050.
1050. Yes, the doc prep fee is 1050. No, that's the doc prep fee is what's 2,500. I got that backwards. Sorry, 2,500 for the doc prep fee, and then our underwriting fee is 1,595.
Kathy, are these fees showing up on the term sheet so they know what
Yes,
they got?
they are. You have all the fees are reflected on the term sheet, as well as we do give you an estimate for third-party fees such as title and escrow. So yeah, everything is reflected right there on the term sheet, so your borrower knows exactly what they're walking into. And again, it is an estimate. We tend to estimate high, you know, versus underestimating. So, but everything that is needed is reflected on that term sheet.
Okay, and I think we already addressed this question, but I'm going to ask it again just to be sure. Will the draws be paid 100% on work completed, or is payment based on the percentage of the LTC that LendSure approved?
Good question. So in some cases, it could be 85%. If the feasibility folks that go out and do the inspections, if they see a bill turned in for $20,000 and they agree that $20,000 worth of work occurred between labor and materials, we'll pay the full $20,000. So that person that does the inspection is the key to how is it 100% or is it 85%? It's the inspector's opinion.
Okay, great. Finding potential borrowers. Now this, you know, getting in with the builder market can be tricky, but there are ways to do it. You know, just start networking and just start telling people, I make ground up construction loans. You've got a ground up, I can help you with that. And then hand it over to, you know, talk to our team here, our fix and flip team. They'll do all the heavy lifting. So your realtor partners, look for online forums, which I'll get into shortly. Look for like local events. Start networking that way. Weekends, there's networking events. There's auctions, investment clubs. I know that there's a ton of investment clubs that are community based. So once you get in with that crowd, you could probably get to know more of these people. Conferences, maybe host a webinar on ground up construction financing and how that works. We may be able to partner with you on that. And local meetup groups. Look for meetup, networking, Eventbrite, other places where people are advertising, hey, investors, come here and network with each other. This screen grab is an actual screen grab from Facebook. And you can see I did house flipping as the search, and look at all of the different groups that are out there that are actively flipping houses, that are talking to each other, that are asking questions, that are looking for solutions. So this is a great way for you to get to know people and offer the help that they need.
Rose, I'll add a footnote to that, how to find these leads and where's this business. So LOs across the country work with realtors every day of the week. A lot of prospecting goes, and LOs could tell us about calling on realtors and what that challenge is like. It's not always that easy, right, guys? Calling on realtors is tougher because you got another 10,000 loan officers doing the same thing, and they're offering 30-year fixed rate money and whatever programs you generally work with. One thing that they may not have is a ground up construction or fix and flip component to their program. So a door opener for you, if you're trying to prospect with realtors, would be a lead with this kind of a loan versus the traditional loans that everybody and their brother is fighting over. So I see this, and I've seen this play out, where LOs have had luck with realtors when they mention these programs first, because it gives you something to talk about that the realtor hasn't really heard about. So it's a leg up for you. Use it as you see fit.
Okay, great. And the application that we mentioned, here's the website for it, but just go to LendSure.com and click on Fix and Flip. You can't miss it. Private label resources. Now, this is part of the stuff that I was talking to you about. If you go to this URL, and I'll send you the URL again in about an hour, you should be getting that. It has marketing materials, not just on Fix and Flip, but on other programs. And it's got flyers that you can customize with your, so that you can customize with your logo, your contact info, your disclaimer, so that you can start reaching out to borrowers and to realtors and referral partners right away. Questions. Now we've got a ton of questions, so I'm going to try my best to get through as many as I can.
3 or 4. We've been on the phone now. These good people have stayed with us for 55 minutes. Thank you for staying with us. I know we're boring, but we thank you for your time and attention. That's for sure. So let's do a few questions.
All right, we've got several questions actually on assets. What kind of assets are you looking for, the builder/borrower?
Can we say a lot of money? A lot of money. So the rule of thumb on assets on a new build, we're looking for someone that has at least $200,000 in some sort of liquid form. It could be, we'll use 401k retirement funds, but we're looking for at least $200,000 on larger projects. I'm building the one in North Carolina is a $2 million plus project in itself. Yeah, they're going to have more assets. So rule of thumb, 200,000 or more on a new build. If they don't have that, it's probably not going to fly.
Okay. How long should the feasibility study take?
1 hour. So when the company gets a hold of the builder and they do agree to meet at the lot, and that's all it's going to be is a lot, that meeting lasts less than 1 hour. Now, it might be a day or 3 or 5 before it's actually scheduled, so they both can have a time frame to meet at the lot and talk about the plan. But the actual inspection on a new build isn't that long. There's nothing there. On a fix and flip loan, it could take longer because we're going to walk through the house and figure out what's wrong with the house and what are we doing about fixing the house. But it's not very lengthy.
Okay. If the borrower doesn't own the lot and we need to pay off the seller of the lot at closing, will you provide 60% loan and the borrower provide 40% at closing?
Case by case basis, yes, that could happen. Experience there would be a real strong must. Big issue would be experience.
Okay. And yes, you guys are going to be getting a copy of the slide deck. Look for an email from me along, so you'll get the slide deck, you'll get the recording. And if you have any questions about this stuff, just go ahead and reply to that same email, and I'll make sure that it gets to Jim and Kathy and get you guys answers and talk about deals as soon as possible. Will the loan advance at closing for documented soft costs, plans, specs, etc., or deposits for things like lumber or windows?
The answer to that is there's no funds go out towards the project at closing. The only funds that would leave the table at closing would be if the lot's free and clear and we're doing a cash back against the lot. Not a dollar of construction funds leaves the table.
And I know that we talked about this, but I still have a few questions on the experience of the borrower versus the experience of the builder.
Borrower experience counts, builder experience does not count.
Okay, great. Is the loan for individual builds or could a builder use this type of loan for community development?
Depends on the size. We don't go past anything past 4 units, where I want to build 4 houses is our max. So larger players doing 10, 20, developing land, putting in lots of homes, but we're not in that business.
Okay. Only stick builds? Can we do the style where most of the house is built in a warehouse and then delivered and assembled on site, not a mobile home?
Good question. Modular homes, the answer is no. We looked into that in the past couple of weeks. We don't do modular homes. Here's a big one that I didn't mention. I should have had it on the slideshow. My bad. I'm a loser again. I should have had it there. I lost again. Half built, new build. I'm halfway through the project. It's a construction stall. I'm out of money. Oh my gosh. I can see a house that's framed. There's a roof on it, not a window or not a door. So there's a structure on a lot that's half done. They're out of money. That loan request would come in as a refinance. They already own it. They've started some work. We see that deal how often, Kathy? Seems like a lot.
Yes. Yeah, that's been a regular here the last couple months.
A lot of lenders won't touch anything that's called construction stall. They think it's some sort of a bailout situation. We definitely have a niche in that arena. We'll look at those deals to figure out how they got to where they got to, what's the equity in the property, what did they pay down for it when they bought it, how much have they put into the construction so far. All of that will go into a loan to value type, loan to cost calculus. So we look at those loans. Very few people do. Construction stalls is a huge player, huge element for us here at LendSure.
And I think you already answered the question about prefab, and a lot of these we've already gone through. So with that, I am going to, and by the way, thank you very much, Jim. You're getting compliments on your presenting style and all the things. Thank you guys, we appreciate it. So with that, Jim, any closing words?
No, thanks for your time. You guys hung out with us for about an hour. Appreciate that. Hope you have a great summer, do lots of loans, non-QM, and hope you can get a loan out of this with a realtor that would lead to you guys some more business down the road.
Kathy, any parting words?
Now, thank you guys. Thanks for the attention, the questions, and yeah, let's close some loans, people. Get them in.
All right, and like I said, if anything, please feel free to respond to that email that I'm going to send you in about an hour, and I will get that right away, and we'll get that answered for you. Thank you so much for joining us, everybody.
Bye.